This is coming. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, Bank of America warns the dollar faces a death spiral as a 1971 style reset is coming. And we'll show you what Bank of America is concerned about and why investors are already starting to hedge themselves against a massive decline in the dollar. And even other experts are weighing in, saying the dollar's day of reckoning is coming soon. Now let's over to Bank of America, where we picked today's story up with a headline from the Flow Show as 1 trillion every 100 days. And that's a lot of money the government needs as deficits are running massively out of control. And here we see from Bank of America's Hartnett, he goes on to say the U.S. national debt is rising 1 trillion every 100 days. That is massive as financing domestic bliss and overseas wars. U.S. budget deficit past 4 years is equal to 9.3% of GDP. Little wonder why debt debasement trades are closing in all-time highs as gold breaks out to make a new high and Bitcoin is skyrocketing as well. And this has got investors concerned, and for good reason, because what you need to see is the economy needs to be growing at a very fast pace in order for the government to run massive deficits. The concern starts to become is as the economy slows, which we've been making the case on the show for a long time, that the problem is the government needs to cut their spending in a big way. The challenge is right now they're not, and this is sending what many believe is debasement trades a lot higher. Let's take a look at what's happening with gold as it marks as higher as U.S. jobs data now boosts bets of an early rate cut as investors are piling into the yellow metal. And here we see gold prices surge to another record high on Friday as data showing a rise in U.S. unemployment rate boosted expectations that the U.S. Federal Reserve could be cutting interest rates soon. Now, why does that matter? Is it has everything to do with the link between what people believe is the Federal Reserve and monetary policy and the value of the dollar. We'll get to that in a moment as gold reached an all-time high of 2,185.19 ounces after a report showed a rise in U.S. unemployment rate and a moderation in wage gains despite job growth acceleration in February. And we've got some charts later in the show to cover some of the things I mentioned yesterday that just don't make sense about the payroll report. But let's get back to gold, because the reason we're seeing investors rush in there is, again, they believe the U.S. government is facing a day of reckoning. The dollar is going to be the sacrificial lamb here. And we still believe the same underlying premise remains, which is a combination of the expectation the Fed is still going to cut rates later this year and dollar weakness. And that is the base case here, because many believe when the Fed starts to cut rates, it causes the dollar to go down, that there is a direct link between the two, because central bankers have direct authority to move the value of the currency through monetary policy. That isn't exactly true. We'll make the case, but nevertheless, it's what people believe here that matters, and that's starting to send the dollar lower and put safety trades like gold and Bitcoin heading higher. In fact, the dollar index was 0.1% lower, making gold cheaper for overseas buyers, while the yield on 10-year Treasury fell more than a 1-month low. And here you can see the federal funds rate being linked to the nominal broad U.S. dollar index. And the case is very simple. It's that when the Fed cuts rates, well, that means the dollar loses value. Yet usually what you see is when the Fed's cutting rates, it's not actually a good sign. In fact, it usually sends people into the dollar as a safety trade. But it's what happens afterwards. You'll notice there's a decline in the dollar, and that's not unusual. What really happens here is, from a global trade perspective, demand for the dollar goes down because it's usually what happens post-recessions. There isn't a huge resurgence in the global economy, and thus the demand for dollars, which is the global reserve currency. But what happens after that is the dollar generally picks up in value as, of course, the global economy starts to come back online and expand. And yet we head head into the pandemic, what happened? Again, the Fed cut rates, the dollar, well, it went vertical. And again, it's that period afterwards. But what the real issue here, the longer term issue, is many people are wondering, how is it possible that the government's going to continue to fund these deficits, pay on all the debt without having to sacrifice the dollar, to debase it, to print money, to do something? And that's what part of the reason is causing people to run to gold and Bitcoin now in a big way. As we see, gold began its record run on Tuesday when it surpassed its December peak, primarily aided by growing indications of cooling price pressures and its traditional safe haven appeal. In fact, low interest rates are supportive for gold, they say, as they reduce the opportunity cost for holding them, suggesting that as rates go down, investors see virtually no difference between holding dollars and gold, with the exception they believe that gold will continue to hold their purchasing power no matter what. And that is a powerful view, because in the government's perspective here, what really needs to happen is the economy needs to turn around and grow. It needs to create enough money through the commercial banking system in terms of new dollars to cover all this debt. The problem happens is when it doesn't occur. But something else that should be surpassing its peak, well, that's your trading account. You know, many people have asked, Steve, do your reports really actually work? Do they generate the returns? Do they have the success rate? Well, I ran some numbers this week. Let me show you what you get. Now, whether or not you sign up for CTA Timer Pro or Momentum Timer Pro, the difference is the CTA, this looks at machine positioning, but we run a historical overlay. So we show you where the machines are positioned before they're usually going to get there. So when they're in deep short positions and they start to reverse, that's an opportunity, because our signals usually lead them. What you get the report, you get the daily signals, and we even throw a video in showing you how to trade them. And our Momentum Timer Pro, how about that? It looks at all those technical signals like the RSI, the MACD, and all those other ones that many people struggle with. They find themselves getting in late and out early, but we smooth them out and add a proprietary signal that no one else uses. Again, you get the report, you get the daily signals, you get the video, and here is the data from this week. I went through and ran a report of every original signal. So if a report generated a signal twice, we took the first signal, put a buy it open at close of Friday. I ran the numbers. Here it is. Out of that, you had 17 trades. This is just ETFs, not counting, of course, the futures signals we generate. Out of that, 12 of them had positive trades. 5 of them were down slightly. It's a 71% win rate, and we give you a free month. Not even my buddy Jay Bravo. He only gives you 7 days to try his. We give you a whole month, and if the 71% win rate on trades, you too can make money. Links in the description below. Sign up, get on that, and start make money trading today, because even Bitcoin looks to be the safety trade against the dollar as huge. New Bitcoin price targets are set after a $2.5 trillion Ethereum, XRP, and crypto surge as investors are going crazy, mainly now because they can access it through the ETF space. With Bitcoin reaching a new all-time high today, is poised for accelerated growth in the coming months. This, according to the chief executive of Bitcoin rewards app Loli. He said in the email statement, pointing to huge inflow seen by the new Wall Street spot Bitcoin exchange traded funds as driving Bitcoin's 2024 gains so far. And there's a lot of truth to that, and Bank of America backs that up. Here we see from the recent report, the inflow to crypto funds year to date of $7.7 billion already exceeds $5.2 billion of the bubble inflow back set in 2021, as investors are crazy right now for dollar debasement trades, looking to gold, looking to Bitcoin, looking to anything to protect their purchasing power. And it makes a lot of sense of what's going on here, because the government continues to run massive deficits. And as we head into a recession, it puts them in a position they're going to have to do something that nobody wants them to do at all. But in the meantime, the only question is, will the government shut down Bitcoin? Because right now, as of April's coming supply cut known as halving, we'll see the number of new Bitcoin rewarded to so-called miners who maintain the Bitcoin network is going to be slashed. And following the halving, increased scarcity coupled with strong demand from retail and institutional investors will likely push Bitcoin's price even higher. This is based on historical trends following the halving of Bitcoin's price, and some now believe it could top 150,000 in value. What do you think about it? Weigh in the comments. Do you think gold goes to the moon, Bitcoin goes to the moon, and dollar goes to zero? Well, there's some more evidence that the U.S. government is going to have to deal with this, particularly Congress, who right now doesn't want to pay attention because the doomsday clock is indeed ticking as U.S. unfunded Social Security and Medicare liability have now hit $175.3 trillion. And again, this is all coming back to the question is, how are we going to afford all these deficits and all of these things we have promised the taxpayers we're going to do for them? And this is exactly what B of A is warning about, is we're going to have to face a 1971 style reset at some point, or something's going to have to change. Maybe the U.S. government devalues the dollar. Maybe we go to a digital dollar and they debase it that way. Something has to change here because a new financial report of the United States government estimates that the financial portion of Social Security and Medicare are underfunded by that much. That is crazy, as Treasury Secretary, even Janet Yellen, signed the report. Here you can see Medicare is forecasted to start cutting benefits in just 7 years. Can you imagine that? How would that weigh on your potential retirement? Social Security's trust funds start running out of money in 10 years, and funds are protected for depletion by 2041. And because of the size of the deficit, there's no clear path to obtaining the funding needed. Means that radical changes could be coming to two of the nation's most fundamental services. So it puts you in a position where the government has to borrow a ton of money. Now, the problem is when the government does it, it pulls it out of the private sector, and that actually can drive the private sector down into recession. This is a dangerous game. This is why you tend to see, fiscal responsibility eventually comes back into play. The question is, can we even get to that point? Because the economy needs to grow. And in order to do that, well, that means the Fed's going to have to do the unthinkable, far even worse than you may even think of going back to zero. Because as of right now, not even Congress can get a grip on things, as they just passed a $460 billion funding deal to avoid a shutdown. And conservatives are irate over the lack of major spending cuts in the bill. And they're going to be even more irate when we get into a recession. Because the danger here is we're going to take on even more debt during a recession, maybe even an all financial crisis, as we're making the case. And all that's going to do is pull money out of the private side of the economy, driving the nail in the coffin deeper, driving the downward push into recession even further than most people expect, and making the climb out of that even more difficult because the private sector will have to rely on the banking system to create money. Well, that means there's only one thing the Fed can do. And here we see from the Wharton School of Business, they're warning that spiraling U.S. debt could plunge the U.S. into a financial crisis as soon as next year. It could derail the next administration. And frankly, I agree with that. If they come up with plans for large tax cuts or another big fiscal stimulus, the markets could rebel. Interest rates could just spike right there, and we have a crisis in 2025. Actually, the reality is we would have just the opposite, because if it was a matter of deficits or total debt that drove interest rates, well, they'd be sky high right now, and that would put notice on the government to cut spending. But that's just not how the system works. The more the government borrows, the more growth and inflation expectations it takes away from the private side of the economy. It actually causes rates to go down. That's even worse, because if rates went up, it would tell us the economy is growing. In this case, it would tell us the economy in the U.S. could be dead. And it could very well happen. He's very confident, at least from the Wharton School of Business perspective, that by the end of the decade, one way or another, we're going to be facing a U.S. debt financial crisis. In fact, the Black Swan author Nassim Taleb, he believes the U.S. economy is in a death spiral. And as long as you have Congress keep extending the debt limit and doing deals because they're afraid of the consequences of doing the right thing, that's the political structure of the political system, he says. Eventually, you're going to have a debt spiral, and a debt spiral is like a death spiral, meaning you have to borrow more and more money to fund the deficits, to fund all the spending, and pay, even worse, on top of all the debt. Again, it just sucks money out of the private economy. And again, that leads to long extended periods of economic malaise. We've seen that throughout history, and this doesn't end well. This from a former asset manager who says, look, this isn't a good situation. And this all puts us back to what the Fed is going to have to do. Because if you think about what we need as an economy to pay on all this debt, to pay on all of these liabilities that U.S. government has in the decades to come, well, we need the economy to grow. And we need to do that by creating dollars, not debasing it. The problem is that's not working because we create dollars through the commercial banking system. Here you can see commercial industrial lending shown in blue is in contraction. That means, well, the banks are destroying money because if they create money through lending, well, as you pay the principal value back, it gets destroyed. Right now, there are not enough new loans being originated to offset all of the loans that are being paid off. And what you can note here is against the federal funds rate in red, when the Fed cuts rates, it doesn't have an immediate impact, but eventually it causes an increase in lending. Now, mind you, we've been at zero once. Twice, we'll be back to zero, but to cover all these unfunded liabilities, well, the Fed's going to have to go negative. That means the dollar is indeed going to lose value. And again, you come back to the safety trade. Why is Bank of America worried about this? Why are investors looking at gold? Why are they looking at Bitcoin? They're looking at anything to hedge against the decline in the dollar because we already know the U.S. economy is headed down. Not a good sign. As we come back to the payroll report that we talked about yesterday, I want to give you an update on some slides I did not include because when we go into recession with massive deficits, well, the government's going to have to borrow even more. Or what we'll say is do the unthinkable, and that's cut their spending in a recession. Could you imagine if global central bankers and governments did that? It would be pandemonium as U.S. jobless rates now hits 2-year high, even as hiring stays strong. But there's some problems in the report because what we can note is that average weekly hours of production of new non-supervisory employees has been on a decline. Now, I'm going to show you a second slide, but I had to cut the pandemic out just so you can see the data here. And what happens is when hours get cut, employers don't hire. And that was the problem here with the last report. We continue to see month after month, the Bureau of Labor Statistics tells us everything's rosy. In fact, jobs are being created. Go out and look for one. Go find another one and go spend some money because it's fine. But yet there's a downward trend in hours worked. And throughout history, that means there's a downward trend in non-farm payrolls, as you see here in blue. Now, I had to switch this to a year-on-year rate of change for the payroll report, but you get the idea. We've seen a massive deceleration in hours worked. That means total pay to employees is going down, and it doesn't make sense. Employers continue to add here. Something doesn't make sense to the point we could see a massive downward revision in the monthly payroll reports or just a big drop in the numbers because even the beige book, even from the Fed's own data, suggests the U.S. economy is not as good a shape as many think. Again, making the case of why something's going to change with the dollar, whether it's direct debasement, whether there's money printing, whether there's forced lending. Something's going to happen as a beige book warns consumer spending slowing due to heightened price sensitivity. Here we can see here Fed mentioned several reports which cited heightened price sensitivity by consumers and notated that households are continuing to trade down and shift spending away from discretionary goods. That's going to lead to more unemployment and put the government in an unfaceable situation. Do you debase the dollar? Do you go back to, of course, pandemic era issues where you force lending to create money by the banking system? What do you do? Can you cut spending? There's really no answer to this because right now the problem is the government continues to spend. And if you take away the discretionary side of the economy, well, here you can see advanced retail sales against commercial industrial lending. As retail sales decline, well, when that happens, it turns out that new orders go down. If new orders go down, factories don't have to borrow as much money. You see this big commercial industrial lending deceleration turns into a contraction, suggesting that this contraction in lending, the destruction of money in the U.S. economy is not going away. The likely path here, where I was going with this earlier, is the Fed's going to have to find a way to take the funds rate negative. In fact, central bankers around the world are going to have to take rates negative. We don't know how that's even possible, but to keep this scheme going without a direct debasement of the dollar, that's the next move. Weigh in the comments. I would love to know what you think is coming because something in our lifetime with the dollar is going to change in a big way. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.